The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box Europe. I'm Karen Cho with Steve Sedgwick, and these are your headlines. Equity markets come under renewed pressure with tech stocks selling off stateside. While in Europe, the Stoxx 600 closes at a one-month low and the DAX drops to its lowest level since June.
The headline act of earnings season. It's all about Nvidia, due to report after the bell today, with analysts expecting a steep rise in sales. Investors bracing for any signs of an AI bubble. And President Trump designates Saudi Arabia as a major non-NATO ally as the country's crown prince visits the White House. The US leader also striking an optimistic tone on the outlook for the Abraham Accords.
We talked about one state, two state. We talked about a lot of things in a short period of time. We'll be discussing it further, too. But I think you have a very good feeling toward the Abraham Accords.
Okay, I find I've had a great debate with the team this morning about whether we care about the inflation data. Genuinely, yes, it's important. Yes, of course we care. But I'm talking about in the lineup of risks and the lineup of concerns. Surely it's all about the budget, regardless of whether the interest rate can go down after the budget or not as well. But here we go. It's not beautiful reading, but it's not the worst possible scenario. UK CPI has come in at 3.6%. I remind you all, year on year, the target is 2%. October services CPI, there is a modicum, a crumb, a decimal of excitement there for the Chancellor because it's coming at 4.5% as opposed to the Reuters poll of 4.6% expected as well. So on the October month, rather than the year-on-year figure, that equates to 0.2% increase. Reuters was going for an up 0.4% increase. I'm not allowed to mention RPI because a certain well-known economist at UBS, my dear friend Paul Donovan, hates RPI, so I'm just going to skip over that as well. But just to remind you that the core CPI ex energy, food, alcohol, tobacco, I know some of you out there are saying what's left in life, is up 0.3%. That is a modicum, as I say, below the up 4.4% that was expected. You get the message. It is okay-ish, but still way too high. Ritika, have I done it justice? Good morning to you.
Good morning to you. Yeah, it's a big debate, isn't it, whether we really care about these inflation figures.
It's like saying to you, do I care about the Fed minutes today? And the answer is yes, but really, let's be honest about it. What we all really care about is Nvidia. I care about them, but not really because there's it's like having, I don't know, a tree present when you know you've got a massive grifter, which is for our viewers who grew up in the 70s, waiting for you outside. It's okay, but it's not the main event.
Yeah, no doubt. Okay, the budget looming, that's going to be the big fiscal event that people care about, whether it is the Bank of England, whether it is policymakers that are going to be watching out for that as well. And as you mentioned, they're coming in at 3.6%, so matching Reuters estimates. And that's actually the lowest in 5 months. Like you said, though, not great, but again, the lowest in 5 months after what it was 3.8%, so nearly double the Bank of England's target over the summer. So it offers maybe a little bit of relief, certainly for the Chancellor ahead of her budget. No doubt she'll have some comments on that, as well as a little bit of relief to households. So we saw, as you mentioned, the services inflation coming in at 4.5%. It was 4.6% that was expected. They were also expecting food price inflation to come down, as well as energy price inflation, which is a big factor in that. Again, in terms of why this matters, well, I mean, it is one of the few data points left before the Bank of England and its final decision when it comes to interest rates in December. Markets putting the chance of a move at about 80%. For a cut, as we have seen some recent data coming in softer than expected. But as you mentioned, the budget is very much the key fiscal event that everybody's going to be talking about. The Chancellor saying that she wants to lower some of those cost of living issues, and maybe that will come through in some of her policies. She wants to give the Bank of England room to cut maybe some modest measures when it comes to cutting VAT on energy prices. But for the Bank of England, I was reading a note by Morgan Stanley, they really see the budget as a hawkish risk because the budget could be inflationary with higher spending and now no rise to income taxes. So they're not breaking that manifesto pledge. So they may not actually have the room to cut.
Since you're both arguing the same point, I'll try and take the other side and just so we can think of it from a different lens. The inflation number could matter here because you've got a Bank of England that is going to be thinking about rate reductions, about 75% chance that December's a live meeting. So as we have a whole heap of MPC members sitting down to decide whether inflation is low enough to reduce rates here to compensate for any growth fade, if they're still presented with a number that is above target, does that become a challenge, not necessarily for the December rate reduction, but for follow-up reductions from there into 2026? That would be one of the questions I would pose today.
Yeah, and I think, Karen, as well, the budget is one event that we're seeing, but you're thinking of it more long-term as well, looking into 2026, not what we're just going to get in a week. And we have had policymakers coming out. They're still talking about inflation. Hugh Pill was saying that he thinks that headline UK inflation actually overstates UK price pressures, but that he still maintains that the Bank of England should still not be cutting rates. And he's pointing actually here that wage growth, he says, is still too high and significantly above that 2% target, given the weak productivity growth that we have seen. So he actually goes in contrast, of course, to the likes of Swati Dhingra, who was also speaking over in Sheffield yesterday and saying that the UK workers have actually experienced little growth when it comes to disposable income. So despite those rising average wages, so due to high costs. So clearly this inflation and wage price inflation as well is still a big discussion.
Richard, I'm going to ask you a question. I don't expect you to know the answer, but let's have a go. What is 84 days? What does that represent? You know, one of those pub quizzes, 84 days.
Oh, can you give me a hint? Or
well,
it's about the budget. It's 84. This is Kingy. This is Ian King's Exchange News. I didn't expect don't worry. Look, I didn't expect you to know. I wouldn't have known. I was like, what are you talking about, Cedric? You're talking like an idiot. Some 84 days after announcing the date of her second budget, Rachel Reeves is finally going to unveil it on Wednesday. I try to be apolitical. I lambast the Tories as much as I lambast Labour. I find very little positive in either of their rhetorics in government over the last few years. But 84 days of indecision, of dithering, of kite flying, which is basically chucking an idea out there, seeing how it lands, and then changing your mind again as well. Of U-turns, of O-turns, of W-turns, call it what you like as well. It is inexcusable for the doubts that has created for British business and for British people looking about their pensions, about their inheritance tax, about their property purchases. Quite frankly, the level of noise, as Ian writes in his Exchange newsletter, is greater than I've ever seen. I've been following budgets since 1988. I've never seen such a shambles ahead of a budget as this.
Yeah, you know, this is certainly a budget with tough choices, and we've seen just 1 week away the amount of uncertainty that you've pointed to, the indecisiveness, the U-turns. Yeah, this is certainly a politics that is, fraught with trade-offs when it comes to it. What I think is really interesting is just how ambitious they are trying to be with this budget in terms of they have to make it A, politically acceptable to the Labour market, B, economically sound when it comes for the gilt market, but then also confined by this manifesto pledge that they put out there into the arena there, and those fiscal rules. And I actually think in trying to do it all, it's expected now that she's going to have to do a smorgasbord now of policy measures. You actually please very few people rather than the initial thing of just raising.
Can I push back?
Yeah.
I think it's the opposite of ambitious. I know what you mean. I know exactly what you mean.
Yeah.
I think it's the opposite of ambitious. I think it is, as you quite rightly say, a smorgasbord, a hodgepodge, a load of sticking plasters on short-term issues. I don't care. I genuinely don't know who I think is good economically in the United Kingdom at the moment. I have disdain for all the parties, and certainly for Reform's crazy manifesto or promises already. But by not being brave enough to make longer-term changes to the tax system, by not being brave enough to make longer-term changes to the property system as well, to the inheritance tax system, to the benefits system as well, we haven't got ambition. We have, as you say, ambitious to cover all those short-term bases. I know exactly what you're saying, and I agree with you, but I'm just so fed up with it.
Yeah, I think we're saying the same thing, but
we are 100% saying the same.
In different ways. Because there are a lot of disadvantages, as you're mentioning there, to this kind of mix and match approach. First of all, if they just raised income tax, that would have actually probably done, now by not doing that, it's actually doing less to reduce inflation. This is expected to be an inflationary budget with higher spending. This makes it also more difficult for investors to assess this.
And don't get me wrong, for anyone who thinks I'm beating up on the Labour Party as well, I think the Tories left them in a terrible position as well. So don't get me wrong, I have equal disdain for both sides of the divide.
And again, you know, in terms of all these different measures, this is likely actually to bring more pain to investors, more pain to businesses, more pain to the wealthy, those that have already got hit from the last tax increases, from the last budget. So this could actually end up harming the economy. And then you mentioned again a lot of the taxes, a lot of the changes that they're not long-term changes. Actually, what this tax system probably needs is simplifying, not overcomplicating.
You know, I went to, you just reminded me, I went to a CBI briefing with the chief economist for CNBC in, I think it was 2007. And it was a huge tome. I may have got my year wrong, but it's roughly about then. How to simplify Britain's taxation system and make it more fit for purpose for the long term. Did the Labour government then do anything about it? No. Did the Tory government for 14 years do anything about it? No. It's a shambles.
I think just to pick up on your point around the pain that is coming to the UK, you are now seeing it on assets, and that is from sterling that is declining because of the fiscal drag. It is on the gilt market for concern that those hard choices are not going to be made, even though in the last few weeks prior to this, it felt as though tough choices were going to be made, so that did move the gilt market. So it's those two asset classes, but also it's the mid-cap space where the market is now exploring some of the downside potential.
Yeah, you're right there. A lot of, I guess, whiplash for the markets too, because it's interesting. Keir Starmer and Chancellor Rachel Reeves really had positioned themselves as those two leaders for the market, and that they were going to have to make those tough choices. We remember that unscheduled speech. Then to reverse that a week later, of course, the markets are watching this, are going to be reacting to it. And then you mentioned again, you know, looking at the FTSE 250 or some of those more domestically focused stocks, those ones likely to getting hit the worst as a result potentially of her policies.
84 days is where I came in, isn't it? We're going to kick off our coverage of Rachel Reeves' make or break budget in earnest from Monday, bringing you everything you need to know before she unveils her red box with experts across the finance and pundits. And tune in for Budget Day itself with Ian King, Wednesday 26th of November for live coverage from the heart of Westminster. All of this available on TV, YouTube and CNBC app. Now I'm getting to the 86 days bit as well. Don't miss Ian's preview of the budget on this week's UK Exchange newsletter, where he mentioned that date range.
Well, let's get to the front and present danger for markets, and that is considered a macro event. It's Nvidia. AI chip behemoth and Nvidia is set to report its third quarter earnings after the bell today. Analysts are expecting the company to post an EPS of $1.25 per share on $55 billion in sales, which would mark an increase of 56% year on year. Orders will also be in focus after CEO Jensen Huang surprised the market last month, revealing Nvidia had $500 billion worth of orders for this year and next combined. Investors will also be watching out for any commentary on sales in China after Huang made a deal with President Trump to obtain export licenses in exchange for sharing 15% of the revenues with the US government. Other things in focus, deal making. Earlier in October, Nvidia took a $1 billion stake in Nokia, which would allow it to integrate its GPUs into the telco's cellular network hardware. The company also pledged to invest $10 billion in OpenAI, as well as $5 billion in former rival Intel. And look at what we're seeing on the Philadelphia Semiconductor Index. Don't forget the basket of stocks reflecting semiconductors has a heavyweight, that is Nvidia. So these have also come off in the trading session. Some of these ETFs, not the only one out there. So 6551 is where we're trading the latest session. Nvidia stock, of course, reversing as well. So one analyst making the point, is the bar now lower for Nvidia simply to climb over it after some of the violent selling we've seen in recent days around the technology stocks? When it comes to Nvidia, we know it's potentially going to be a beat. I mean, that seems to be on the back of all the evidence that has been gathered. Very strong orders coming through, ton of deals done by Jensen Huang. But the focus seems to have shifted to the capex side. What the hyperscalers have announced, whether they continue the same pace of spending and if it's going to be financed by debt, or whether they ultimately also have to pull back on that capex pace because the market simply says no. So there are some dangers here, and the question is whether Nvidia can steal the narrative today and change fortunes around for the technology universe.
Yes. And there's a very good piece on Goldman Sachs talking about that how that capex spending is going to go down very, very aggressively that they put out in the last 24 hours as well. But it's the debt attached to it, as you say, which many people are beginning to worry about.
Yeah, 81 billion in debt. Sorry, just to remind you, 81 billion in debt from 4 companies since September. But these are companies with a combined market cap of $8 trillion.
Yeah. I think the number's even even more extraordinary. We estimate that companies could add 700 billion in net debt to their balance sheets without lifting their net leverage above 1 time. So that doesn't look like scary for anyone.
But makes you wonder 700 billion.
But it's elsewhere in the AI infrastructure that people are worried about the debt being raised, not by these hyperscalers as well, because they can cover it from cash flow. We don't know. The truth of the matter is, we don't know what the whisper number that the algorithms are going to be looking at for Nvidia today. We don't know what the positioning is on Nvidia. We've seen a lot of 13F filings and a lot of whale activity. The truth of the matter is, you can justify it being a good purchase or a good sale, depending on what number you look at. And herein lies the problem as well. They will beat expectations because 75% of US companies always beat expectations because you call it down and beat. But if you look at a price earnings ratio going forward, it trades at a very modest level compared with some of these companies, 27 times forward. If you look at a price to book or a price to sales, it trades at a very immodest number as well. So it's those forward sales figures which I think is where the scare is going to be as well. But I will hasten to add, if you're looking for scary numbers in the AI sector, you won't find it in Nvidia. You're going to find endorsement of the fact that this company still has its moat. And that's the other thing, is the moat still going to be intact in 2026 and 2027 as well. If you want to find the scary numbers, you have to look to OpenAI, which is in the private sector, of course, as well. A company which is expected in 2025 to make 15 to 20 billion US dollars in sales, but trades on a valuation of what? And therein lies the problem. It's gone up from a 60-odd billion valuation a year or so ago to, I've seen a number being touted around, whisper it, of $1 trillion is what they want for their IPO when they get it as well. Those numbers, for me, terrify me.
Let me just give the traders something to think about in terms of the bookmark on the stock today. There is a view that you could see a swing of roughly 8% on the share price, higher or lower on the back of the earnings. That's according to CBOE Global Markets data. So just pinpointing some of the sensitivity. I've long argued that Nvidia could be one of the challenges for some of the ETFs, given the line share that it now has, the concentration risk we've seen around Nvidia. But the reality is, if you look at the major indices as well, they have now dropped below their 50-day moving average. So are there also technicals at play on the index level, not the stock level now, at the index level, that could circle back to impact Nvidia as well? Now, just to take a look at those numbers, Nvidia results could weigh on a number of tech and chip stocks, not just in the US, but worldwide. CNBC has compiled a list of those names you should also be watching tonight. You can see that on CNBC Pro. Coming up on the show, we are officially 1 week out from the UK budget. With today's softer inflation figures, a welcome reprieve for the Chancellor. Riddick will be joining us again to discuss. Plus, Trump declares Saudi Arabia a major non-NATO ally. Following meetings with Crown Prince Mohammed bin Salman at the White House, Dan brings us the latest. And private capital is in focus amid the ongoing AI spending frenzy. Juliana is on the ground at Carlyle's Private Markets Conference, where she'll be speaking to the CIO of Schroders Capital, and that is at 9:30 London time.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick. Here's the CEO of the London Stock Exchange Group, Julia Hoggett.
There is no justification whatsoever for not doing the right thing, even if the right thing is hard to do. Which also means that if the context changes or the information changes, it is absolutely fine to also change your mind.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this. Have you ever wondered out there, if Tesla paid all this money to Musk so that he can stay and develop AI within Tesla and not rush off anywhere else, why he's got another company also developing AI, which also trades at a big valuation? Anyone thinking about that? No? Okay, I'll move on. Because we have a flurry of news out of the private markets overnight. Here's your funding round roundup. Elon Musk's XAI, this is my point, is reportedly in advanced talks to raise $15 billion, at a valuation of $230 billion. This, according to the Wall Street Journal, which says the terms for the funding round were outlined to investors by Jared Birchall, Musk's wealth manager, on Tuesday night. The newspaper says it currently isn't clear whether that valuation is pre or post money. Either way, the figure is a huge increase on the $113 billion XAI disclosed after it bought X.com in March. And if you're worried about valuations in the public sector, then maybe you should be looking at the private sector. Just saying, for a friend. Elsewhere, crypto exchange Kraken says its valuation has increased by a third in less than 2 months. Isn't that interesting? Crypto exchange Kraken says its valuation has increased by a third in less than 2 months, at the same time where we've seen a 25% decline in Bitcoin. After it was valued at $20 billion in its latest fundraise, even amid the broader crypto market jitters. Well, none of that makes any sense to me, but it will do to Juliana, who is live from the Carlisle European Investor Conference in London, where private markets are in focus. And I can tell from the way you're sitting that you're about to do a turn to a guest.
Well, Steve, you're a good predictor. That's right. We've got Jason Thomas with us, head of global research at Carlisle, which is a great time to have you. Thank you. And Steve was just outlining some of the latest news in private markets. It's been quite a time in both public and private markets. We are here at Carlisle's annual European Investor Conference. Let's kick off with investor sentiment, what you've been hearing from your investors over the last couple of days.
Well, the big topic, no surprise to you, is AI. And I would say that investors still have the same excitement, the same degree of fascination about the potential, but now this has been leavened to a large extent by concerns about valuation and concerns about concentration risk in the US market, of course, particularly. And I think that it's important to note that these markets are two-sided. You know, the management teams of the frontier AI labs and their partners providing the computational capacity should be making big promises. They should be dreaming big. They should be investing aggressively in projects that they think have the transformational potential. But it's not incumbent upon investors to believe them. Investors, of course, have to ensure that they are getting compensated for the risk, that things don't work out quite as planned. And I think that there's a sense that perhaps there's been some assets in the space that have been priced to best case scenarios. So I think that that's the reassessment that's going on right now.
And when you look at valuations in both the public and private markets, is it worrying to you? It sounds like you think that perhaps valuations have run a little bit too hot.
Well, you know, I think that one thing that we've emphasized, particularly as it relates to the hyperscalers in the United States, which is Nvidia's biggest customers, is that there's been this subtle change of strategy. What I mean by that is these companies were really largely virtual businesses, asset-light businesses. So they traded at very high price-to-book ratios, which made a lot of sense. You know, you don't value a money printing machine based on the cost of the paper or based on the cost of the printing press. And that's essentially what they were, these massive money printing machines. Most of their assets were intangible, proprietary technology, the digital platforms. And now they've actually started to invest so much that 70% of their cash flow is being consumed by capital spending. And if you look at their book value, now 70% it actually consists of property, plant, and equipment, largely data centers. That's a fourfold increase from a decade ago. So I think the question is, should these companies continue to trade at price-to-book ratios that are now on average about 11 times, now that they're not quite the virtual businesses they once were? They're now, in some cases, look more like a manufacturing or an infrastructure company. So I think that's, again, where some of this reassessment's occurring.
It seems like a lot of the concern is also centered in the fact that companies are remaining private for longer. So they're ballooning in size in the private sphere. When you look at a company like OpenAI, as recently as last week, you have some analysts calling for a valuation of $1 trillion market cap for it to come to market. What are the implications of the private market fueling so much of this boom?
Well, I think that what we've seen over the last 20 years is private equity was at one time really a barbell. You had early stage venture, you had late stage buyouts, which was very often public to private delistings. Over the last 20 years, that barbell's been filled in. You can now stay private for as long as you want. So the electing to stay private is simply, in many cases, because that option didn't previously exist. But I think what we've also seen is that many companies would prefer, management teams would prefer not to have a constantly churning shareholder base, not have to spend 1/3 of their time essentially marketing to analysts, marketing to shareholders. So staying private essentially allows them to focus on executing and the strategic decisions with their business. But finally, there has been a change also in the nature of the economy. In the past, of course, most of the assets were tangible. You had fixed assets. They could not be stolen. No one can steal your factories, your equipment. So going public didn't have a competitive risk. Today, more of the value of companies is, of course, intangible. Proprietary technology, business methods. These are things where I think there's a reasonable concern about disclosure. Is a competitor, or are you inviting a would-be competitor to come into your market, take your business? So there's a desire to remain private longer just for competitive reasons.
That's a really interesting factor to consider here. Let me ask you about the U.S. economy. Clearly, the market has become quite jittery over the last couple of weeks, in part because of AI valuations, but in part because it's unclear how healthy the U.S. economy is. We've been in this data vacuum here. I know Carlyle puts together some proprietary data, and you've been looking at the U.S. economy through the lens of a lot of your portfolio companies. Shed some light on where you think the U.S. economy sits right now and where it's going in the coming months.
Well, what we have seen is an acceleration in the U.S. economy from the middle of the year. So right after the tariff shock, it looked like U.S. growth had decelerated to about 1%. So our measure is real final demand. It's our proxy for GDP. It's derived from about 160 portfolio companies, real-time data, order flows, current business volumes, prices paid, prices received. What's been interesting is that acceleration in growth has come at the same time that hiring has slowed materially. And I think that it's the challenge right now is to explain this disconnect. I think partly it's related to immigration enforcement. Over the last 3 years, the U.S. had net immigration of about 2 million per year. This year, net immigration might be 0. So that, of course, has a big labor supply constraint. Secondly, of course, there is tariffs. There is signs of narrowing margins. Those businesses affected have slowed hiring in response. And third, I think AI is playing a big role. And it's not just AI taking people's jobs. It's also, I think, businesses thinking about how to integrate AI into their systems. So there's a rethink of workflows. And I also think that we've seen in some cases businesses that are actually trying to find efficiencies to create space for more AI investment. And so I think it's a confluence of those factors as to why this very unusual disconnect, economy up, or again, real demand up, but employment growth slowing.
Where does that leave the Fed? Do you think an interest rate cut in December is warranted? Do you think it's coming? And what about in 2026? It feels like that is perhaps more important for the market, and in addition to all the economic data and what that is telling us. We've also got the prospect of a change at the helm at the Fed.
That's right. I think that right now you do have 3 governors who very much would like to see a rate cut in December, but you have lots of other members of the FOMC who are uneasy about that, precisely because of the uncertainty, what's driving the deceleration and hiring. And if it's more on the supply side, well, actually, additional cuts wouldn't be warranted. What's interesting about the United States right now is if you survey voters, if you look at public opinion polling, inflation and the cost of living is still the top issue facing the country for a plurality of voters. And this is something, of course, that elected officials are looking for ways to address. But, of course, the best way to address concerns about increases in prices from these levels is to leave rates unchanged. And so I do think perhaps as the midterm elections approach next November, if inflation remains stuck at 3% or perhaps even moves up a bit, that there'll be a reconsideration about future rate cuts in 2026.
Let's wrap up on Europe. We are here at Carlyle's European Investor Conference, and one of the big themes this year has been the resurgence of Europe from an investment perspective across both public and private markets. A lot of that has come amid this pivot from European governments to spend more on defense, a recognition that security is paramount. How do you think about the opportunity in Europe here, and whether Europe can really build the kind of innovation ecosystem that we have in the US?
Well, I think that the trade deal in July really alerted European leaders to the idea that if they want economic autonomy, if they want to be seen as co-equals at the negotiating table with the United States, they need broader strategic autonomy. So I think that's the first part, and that can only be purchased through increased defense spending. Secondly, there's been more talk in Europe about this peace dividend. How much of a dividend has it really been, given that European productivity has lagged that of the United States? And on the other side of that equation, how much of a burden has this defense spending in the United States really been, given the very obvious spillovers from this defense R&D onto commercial applications and also crowding in private sector R&D? So I think that this isn't just about larger budgets in Europe. It's about a fundamental reorientation of defense spending and having the systems and technology that's developed domestically and also manufactured domestically. And in that context, the defense becomes less of a burden because you're not just importing hardware or systems, you're actually building it domestically. And again, I think the spillovers and the potential development of the domestic tech sector is something to watch very closely.